Good morning. Welcome to a What's Up with the Markets session. Called it Climbing the Wall of Worry. And I think that is, although it's a typo, it is appropriate for what's going on at the moment. Before we get into it, I have to remind you that everything that we cover here is generic technical analysis that I cover in this webinar. And none of it is used in SPA3 investor, SPA3 trader, SPA3 income, or SPA3 crypto. We use mechanical principles, mechanical rules, mechanical criteria, rules-based, non-discretionary, whichever of those you want to call it. And none of this generic technical analysis is used to make decisions in any of the public portfolios. Goes without saying, but we'll say it anyway because they use SPA3 investor, SPA3 crypto, and SPA3 income. And I don't use any of this generic technical analysis in my own trading, either the public portfolios that you see or even in the non-public portfolio, the other portfolios that are run outside of those as well. I trade those 100% mechanically. There were, when we did have mechanical systems, go back 20, 25 years ago, where I used to tinker and tamper a bit because I thought I knew better. But years of experience have shown me that I didn't when I used generic technical analysis. So I am a 100% mechanical trader, have been for over 2 decades, and precisely follow the systems. And that 2 decades for new customers that are seeing this for the first time kind of coincides with my relationship when I met Mark Douglas, and it really rammed home then. And before we get into looking at the charts, I must tell you that everything we do cover here today is generic investment advice. There's no personal investment advice, and none of what we covered today should be taken to go and make decisions outside of the rules and the principles that you follow in the systems. Let's get into looking straight away at the Dow Jones, and what we see here is obviously there's a sell signal that's occurred. That's the red arrow that you see on the right there. And what you can also see is a little bit of underperformance down near the bottom here, a little bit of underperformance relative to the S&P 500. Now that typically happens when the markets are rising, when they're stronger. But here we have a little bit of weakness in the markets, and I think I'll tell you the theme right now is that when we go through these charts, what we're going to see is a little bit of confusion, and you'll see that towards the end when I cover the last charts that I cover. But we'll set the scene with the large cap major indices and also the commodities, and what you're also going to see is that in the actual equity indices themselves, even though there's a bit of confusion going on, is that the indices haven't fallen by as much as what they should have, given the status of what's going on, this big event that's happening in the world at the moment. So we do have a short-term downtrend here, but the long-term uptrend very much still intact. And from a medium-term perspective, which is really where SPA investor fits, sure, we've got an exit signal there, and with a medium-term time frame, you would expect that. But the longer-term trend is still very much in place, and it's still in the upper half. So if we've got this median line going through the middle here, the dotted line, you can see that on the Dow Jones, we're up in the upper half of this. So there's still, excuse me, more room to move to the downside, for this to be a retracement or a breather, that you'd expect in this sort of time frame. So even given the gravity of what's going on, it's the trends are still holding up. Similarly with the S&P 500, there's the longer term trend there. From a medium term perspective, you can see we just dropped out of the upper half over here, and I'll just zoom in a bit. And sure, we had an exit signal there, and we're basically going sideways with a bit of a rounding top forming here. It's the only equity index we're seeing that forming. That is a bearish formation, but we're not seeing volatility that's that high in the large cap index. Sure, it's come above this bottom line here of 1%, but high would be up towards the top end of this channel here, towards this upper red line. So we're still very much going along. 1.4% volatility for the S&P 500 is over the long term is relatively low. Look at that. It's relatively low. So whilst it might feel like in our individual portfolios there's a bit more volatility, I'm certainly feeling it in the public portfolios in both the US portfolio, that it comes down to individual stocks, and in the ASX, it is it's not as bad from an index perspective as what you'd expect. Right, looking at the cumulative new high, new low breadth of market indicator, which is this gray line along the bottom over here. The blue line is the S&P 500 index. We do have divergence. We're seeing new highs and new highs have been outweighing new lows in this bottom line here, but we're seeing lower peaks in the index. But we're starting to see a drop off now in where new lows are starting to just a little tap down at the bottom over here. So that divergence is indicative of market weakness. And in the cumulative advanced decline line, we're also seeing divergence as well, where you're seeing more stocks advance than decline, but we're seeing lower peaks. So that's also indicative of breadth of market weakness. And you would expect that in what's going on at the moment. But this divergence did start before this war started. And both of those breadth of market indicators. Number of stocks above the 150-day moving average are also a breadth of market indicator. We're not seeing divergence here. The lower peaks are coinciding in the actual indicator, is also is coinciding with lower peaks in the S&P 500. And we've had quite a dive over here of the number of stocks above the 150-day moving average, but still, over half are still above the 150-day moving average. So we're not seeing capitulation and weakness like we had over here that you can see in this period, which was about a year ago. But there is weakness. And again, for the gravity of what's going on, just to put that into perspective, this year was Liberation Day when the tariffs were all discussed last year, mentioned last year by Trump, and we saw extreme weakness there. Whereas here we're not seeing the breadth of market indicators that we've seen so far are not the same as what was happening back then. So there is confusion. That's, I guess, the setting scene for some confusion. Right, this is the US dollar v the S&P 500. So this is the US dollar basket index, if you like, against 6 major currencies. And so what we're looking for here is, and this is a major indicator, is a rising dollar typically means a weaker market. And the basket, the US dollar, although it did have some weakness, has started rising just recently. Excuse me. So we've had a situation here where it's bull market conditions, where the US dollar's been getting weaker and weaker and weaker, but we just ticked up. In fact, that happened with today's data. We've just ticked up above 10 over here, which is when I would put on I put on the red line and I'll just do that now to show you how I do it. And that would go right over there. There we go. So that's just happened. So this is an indication of weakness. Typically, this will last for a little while. So as we see the stronger if the US dollar does continue to strengthen, we're probably going to see a little bit more downside pressure on the S&P 500 or on equities. Right, this is looking at growth stocks versus value stocks. So growth at the top, value at the bottom over here. The relative strength has been showing weakness. So that came up in December, 1st of December last year. The weakness started. What are we saying? Because growth stocks are a risk-on indicator, and so when growth stocks are outperforming value stocks, that's a risk-on, if you like, sentiment indicator. And when value stocks are outperforming growth stocks, that's typically an indication of money moving to safer havens and lower growth and more stable, solid companies. And so we've seen, you can look at the naked eye over here, going back to the beginning of November where it peaked. We've seen growth stocks falling. That's the growth stock index. And we've seen value stocks rising. And hence that's played out into our CIROC over here, which is a smooth index of the relative strength line, which is that middle line over there. But we're starting to see an uptick over here now. And the relative strength line's just crossed above its 34-day moving average. So, and you can see this is flattening out, growth stocks flattening out, and value stocks starting to fall. So is this a shift? Is this a shift, for the early money starting to go back into growth stocks? It is, because that's what the charts are telling us. But certainly the switch hasn't totally happened yet. We would keep an eye on this, on the smooth indicator over here of that relative strength line. But you could also look at the naked. You could do analysis on the naked indicators as well, so the naked indices as well. So that's the first little sign of maybe some turnarounds. What are we looking at next? We're looking at the consumer discretionary index, the top versus the consumer staple. And so typically when markets are going well for your risk on environment, you are looking for discretionary to outperform staple. And similar to growth and versus value, this is a sentiment indicator, and we have certainly seen weakness in discretionary and growth and strength in staple, and that is indicated here. So when did that come up? On the 26th of the 1st, so January, and we've seen this weakness in discretionary stocks. So the turnaround hasn't happened yet. There is a bit of a flattening here in the relative strength line, meaning that they're kind of going the same. You can see staples are starting to fall off. So very early days, but similar to what we're seeing in growth versus value indices as well. So there might be some early signs there. And what we're going to be looking to wait for is this, upturn over here in the CIROC of the relative strength. But of course, the relative strength line will itself move earlier, as will the price action. So that is maybe a bit of an early sign. Looking to the put-call ratios on the S&P 500 constituents, and what we're looking for here. I just used the CIROC rather than looking at all these squiggly lines over here and doing analysis on it. The bottom chart is the S&P 500. The top graph is the put-call ratio, which is registered every day. And then I've done a smoothing of a 250-day moving average, which is an annual average, 252 trading days in a year. And you can see that this is rising. When that's rising, it means that there's a favoring towards puts rather than calls, which means it's a bit of a bearish. There are people hedging their bets, if you like. There are large investors, institutions hedging their bets, which gets this going up. So there's caution, if you like, amongst the large investors, and at this stage, puts are winning out. Even though there's been a drop over here, and just recently, that is the longer term trend, if you like. The smoothing of what's going on is telling us that puts are still in favor. Right, looking next at yields, so 20-year Treasury bond yields. Yields are rising and could get back into this channel here, just about touching it, which is why I keep that channel there. And what is that telling us? Even though we had a risk on, so even this was saying that relative to the S&P 500, which is the bottom chart over here, we can see this starting to turn now. It's a 34.13 CIROC, so it's not short term. And but at this stage, watch yields, because when yields rise, bonds fall. And you can see the bond starting to fall here. This is the 30-year, this is the 20-year Treasury bond. So this is not yields. So bonds go opposite to yields. And you can see that now the bonds are in unison with the equity index, which is typically what will happen for a risk-on environment. So so that is also showing a little bit of weakness, if you like, towards this whole picture we're painting here. The VIX index, the fear index, has not reached extreme levels. So this here is what happened in Liberation Day last year in April 2025. And you can see that we certainly are getting the volatility starting to get a bit high. I've got an ATRVE, but the VIX index itself is also a volatility-based index. And it's just showing short-term volatility. So still, this range here, this gray range, which is rising slightly, it's still below the long term. So why have I put that? This black line here kind of shows peaks, and the bottom is the troughs, the very low levels. We still haven't got out of this long-term range. So you would have expected, sure, there's been a spike, there's no doubt about it, but sitting at 24 rather than in the 30s is not extreme volatility. So the VIX should have been a lot higher than what it is, in my view. But this is kind of, showing that it's not quite as bad as things are, well, certainly not back as April 2025 over here when the tariffs were announced. So what are the markets telling us? So what we've seen so far, from how the breadth of market indicators and the sentiment, or particularly the breadth of market indicators, reacted in April last year, how the VIX index has reacted, and the volatility of indices, how they've reacted, is that financial markets are not seeing this war with Iran as badly as what they saw the tariffs. So which war had a bigger effect on markets? And so far, looking purely at charts, is that the tariff war had a bigger effect on markets than the Iran war. Now that's going purely at the charts, and that's me reading the charts. I'm sure we could all have different views of other environments that are not a financial markets environment. Sure, there have been one or two commodities, i.e. oil, particularly has been affected, but we'll have a look at that at a moment and compare that relative to past events as well. But right now, the Iran war, from a financial markets perspective, has not been as bad as the tariff war. Go figure. Right. Let's now look at the Nasdaq composite. It also gave an exit signal, if you like, so tracking sideways. It is underperforming the S&P 500, which is typical of a risk-off environment. So that's telling us that things are, from a financial market, from an equities perspective, is that there's more weakness than strength around. And if we look at the Nasdaq 100, similar sort of thing. There was the exit signal and been going sideways ever since, relative to the S&P 500, underperforming. There's the relative strength line, that falling blue line telling us that there's weakness. So typically, in a risk-on environment where things are going gangbusters in equities markets, you'll see the Nasdaq composite and the Nasdaq 100 both outperforming the S&P 500, which in turn you'd see outperforming the Dow Jones. So we don't have that at the moment. So there certainly is indecision, a little bit of confusion, taking stock, waiting to see what happens, how long this war is going to be, et cetera, et cetera. But right now, the financial markets, certainly the equity markets, are betting on that this is not going to be too bad and is not going to be too prolonged. Of course, if that changes, we will see an immediate effect on the markets. If it changes, if it ends, you'll probably see a bounce. If it goes longer, which I'm probably stating the obvious now, then you're going to see a fall in the markets. But right now, the markets are waiting to see what happens. Sorry, this is probably just the data. But effectively, if I do this, it'll be better. Oops. Let's do this. Okay, that shows that there was a little bit of divergence going back in January, February, but that divergence, when the data fixes itself for the next download, is not in place if we're looking at the cumulative new high, 52-week new highs versus 52-week new lows on the Nasdaq 100. And similarly, there is divergence on the Nasdaq 100 cumulative advanced decline line. What you're seeing is there's still more stocks rising than falling while the Nasdaq 100 falls. So that's a positive sentiment. That's being a breadth of market indicator. That is a positive thing for the markets. We also haven't seen the Nasdaq 100 stocks. Those that are above their 150-day moving average are not falling. So they're staying above their 150-day moving average, which aligns with a little bit of indecision, but also the fact that the positions are holding up. They're holding up. They're not falling that much across the Nasdaq 100. And again, it's probably this wait and see. The SOX, which is the Semiconductor Index, also strength here. I mean, this is a risk-on environment. So what this is saying is that the semiconductor sector is outperforming the Nasdaq 100, and we can see that at the bottom over here. So that's staying in place, and you can see in the price action here, there've been two little falls, but in the long term, whoops, let's have a look, just not too long term. In the long term, you can see this trend is rising. There was strength there coming out of April last year, and this trend is still up. There's no doubt about it. We haven't yet had a lower low. You can see that there's peaks up there and there is resistance there, but that certainly is holding up in the tech index. I included this the Toronto Stock Exchange index here. So that is that line is the Toronto Stock Exchange, and the blue line is the All Ordinaries. And just to show two resource-based markets, how one is outperforming the other, and over the long term, there's a very similar. Let me just fix this up and go to all data. So this you can see a better chart here. So that's the long-term TSE 60, Toronto Stock Exchange 60, and you can see how the shape of it, besides a little period over here, the shape of it is very much the same as the All Ords, and the shape is a lot closer than what you'd find the All Ords against the S&P 500. But just here, there's been this massive divergence take place between Australia and another, and the same if you compare the All Ords to the South African market, you'd also see this divergence. And I can't explain it. I don't know what it is, except that there is probably a more positive view of the resource stocks in Canada and South Africa than what there is in Australia for some reason or other, or that because we certainly do have a big mining and resources focused index. But there are other parts of our market that are holding this back where that's not the case in the others. So we've got pretty much extreme divergence there with our index compared to other resource-based indices. Okay, there is the All Ords. Look at this confusion. It's real up and down, quite large moves. Indecision, confusion, throw the whole lot in there, and certainly more so than other international indices. When you look at the Australian dollar, this is indicative of, because remember we looked at the US dollar basket, that was holding up against, in fact, it was getting stronger. The US dollar was getting stronger against the other currencies, but certainly not against the Australian dollar. So the Australian dollar is getting stronger. Why is that happening? Is getting stronger. There is resistance at this level around about 70, which is probably the extreme long term. You'd probably put through 70 to 75 is the long term Aussie dollar v US dollar mark, and we're getting to some resistance at the 75 at the 70 level over here. So you can see there's lots of support and resistance at this level. So we'll see what happens, but there has been a breakout above it, and this is probably indicative of some money coming into Australian dollars, and this divergence of stronger Aussie dollar against the US dollar, but US dollar stronger against the basket of 6 currencies, of which the Australian dollar is one. So it's there is that bit of, as I say, divergence happening between the two, which is unusual. So this is saying that the Australian dollar, and I haven't gone and done the other crosses with the other 5 currencies in the US dollar index, but you can do that. But what I would hazard a guess at is that it's the Aussie dollar is also outperforming those other currencies as well. So there is buying of the Australian dollar, and that does happen. If money comes into our market, it's one of the ways that it can rise. And also we also have interest rates that are a bit higher than other parts around the world, and it looks like we may even go a bit higher again, which is the carry trade, which also does bring money into the Australian dollar as well. So that is going kind of counter the rest of the story with currencies. Okay, just looking at other markets, the Nikkei has been very, very strong, above its all-time high from back in 1989 and staying there and getting stronger. We do have a sell signal there, but look at this relative outperformance of the S&P 500. So Japan flying. The DAX is in very much confusion mode, underperformance of the S&P 500, now kind of tracking sideways, so matching it, but looking for this is going to resolve itself pretty soon, I think, and it's going to have a major. Oh, there's something wrong with this mouse. It's going to have a major breakout of something like that, because look at the sideways movement. That's indecision, and I guess it's waiting on the war, but either one way or the other, it's going to be a big breakout to the upside or the downside. The FTSE is enjoying probably one of its strongest market runs that it's had for many, many years. It's above its that's the 2000 top over there, and you can see it took so much longer to get above and stay above, and it looks like it's above now. But this longer term sort of 20-year the 20-year trend that I've got here, it's right near the top of it, but it does need to get stronger. You'd expect or hope it to break out the top of that, but it's despite all the things happening in the UK, the FTSE 100 is doing well. Right, the Bovespa, for developing markets, outperformance. Look at that breakout, key breakout, very much rising. The long-term trend is over there. It's been in the bottom half to the lower, and now it's run about the median. So it's got a lot of upside, and that's indicative of developing markets. And you can see outperformance of the S&P 500 along the bottom. Chinese market, large cap stocks, kind of there's definitely been a breakout of that downtrend over there, but still not out of that long-term trend. But interestingly, with the all-share Shanghai index, there has been a breakout. Look at that. So that's going back all the way to 2007 when that peak was made. So we're talking nearly 20 years in this down, sideways, secular bear market is what the Shanghai all-share index has been in. But we've just had this breakout here. So that is a pretty 2 touch points there on that upper trend line, a breakout over here. And that could be, well, let's keep an eye on it. Let's see if it doesn't retrace back into the range, or whether this breakout does continue. So keep an eye on the Chinese market, despite some not so good news coming out of there from an economic perspective. Right, the Hang Seng, which I've included recently, also indicative of what's going on in China. Still, that goes all the way back to 2007. So been in a secular bear market for all that time. What is it now? It's 30 years since the 1997, and we don't need to go into that too much, but you can see that long-term sideways move. So keep an eye on that. Also indicative of a broader Chinese market. South African market had a breakout. You can see that's that rise over there. And if we had to do in fact, the bottom here is the All Ords. So similarly to the Toronto Stock Exchange, if we had to put a line, if we had to do this, you would see from around about that's where the breakout was. It was back there, but if you go from when that part over there, or around about here, you can see that the Australian market's basically gone sideways, whereas the South African market has risen. So that's another resource-based market that is outperforming. Before going to the commodities, I'll just go finish on the indices here. This is where the confusion's coming. I was going to do it at the end, so I've just slipped this in now. Looking at the S&P 500 equal weighted index, you can see there's outperformance here of the S&P 500. And that is because, and it's still an open trade. So there's an open trade using Sparse Investor only just, which is not the same as the S&P 500, the Dow Jones, the Nasdaq 100 are all in the last signal was a sell signal. But you can see rising relative strength over here, and it's a risk on. So the Ciroc is rising. So we're seeing the S&P 500 equal weighted index be outperforming the S&P 500 index, which is typically a risk on type indicator or sentiment indicator. And that is because the mid cap stocks and the small cap stocks, which and again in the S&P 500, so the mid cap are the S&P 400, the next 400 stocks after the S&P 500, and the small cap stocks are the S&P 600, which is the next 600 after the top 900 stocks. And the equal weighted index has equally weights the stocks number 101 to stock 500 in the S&P 500 with the same market, with the same position size, if you like, as the top 100. So we're seeing even the smaller cap stocks of the S&P 500, outperforming the larger cap stocks. And that would typically happen when there's more confidence in the market and a higher sentiment in equities. And we're seeing that now despite what's happening, which is unusual for a high volatility risk off environment for small and mid cap stocks, and even the smaller cap stocks of the S&P 500 to be doing better than their larger cap counterparts. So even though the mid cap's given an exit signal over there, you can see the relative strength compared to the S&P 500 is the S&P 400 has been outperforming since, since November 2025. And we have that risk on over there. So this is where the confusion comes in. If the war continues to go longer and it really does get pretty bad, you'd see the small cap stocks and the mid cap stocks and the S&P 500 equal weighted index underperforming the S&P 500, and you'd see a flight to value, you'd see a flight to staples, and that isn't happening yet. For the severity of what's going on, certainly in the mainstream media, you would expect things to be worse. They are not, and they're certainly not as bad as what they were in April last year. So talking of April last year, look at how the small cap stocks reacted in April last year, and look at how the mid cap stocks reacted in April last year when the other war, the trade war, was announced, and there's the S&P 500 equal weighted index in April last year. Which war is worse for financial markets? I'll leave it to you to decide. Okay, let's just go over to commodities quickly, then we'll finish up. Before I do that, are there any questions? Okay, so Simon's asked, what does risk on and risk off mean? Good question. Risk, it's used in the financial services or the financial markets, particularly equities. You won't find, you'd hear brokers talking about it, financial commentators talking about it. You won't hear financial planners using that too much. Some might if they're equities focused, but if they are mutual funds or managed funds focused, they probably wouldn't use those terms. But risk on means that it's where money will flow into equities, and people will be overweighted money managers, portfolio managers would be overweight in equities compared to other asset classes. So the risk goes, you start taking risk in equities because a positive environment, if you like, is expected. Risk off would be bailing out of equities and going into more safer asset classes, if you like. So these sentiment indicators and these breadth of market indicators that I look at are absolutely ideal for working out the whether there's a positive sentiment towards equities at the moment. So we use a number of these, and it just gives a feel for the environment. As I say, I don't use that to make decisions. The decisions, and I look at this literally, whenever I do it for our customers when I do these webinars, is the only time I look at these. And it's not bad to do it because what you want to do is particularly when things go a little bit haywire in the world and the geopolitical scene gets a bit volatile. So things that are outside of the financial markets, that commentators will generically use those geopolitical events to use subjective opinion to provide what they think is going to happen in the future, because everybody's trying to work out what's going to happen in the future, except us mechanical traders, of course, is they will use those events, and of course they will overdo the sentiment and paint a really bad picture, and you'll see things like $95 billion wiped off in the market, and they won't put into perspective that maybe $1 trillion had been put out, had grown in the market in the last 12 months, and that this was only a 10% fall of what had grown in the life. They don't put it into perspective like that. They take the one-day sensational view. When the market rises by $100 billion in a day, they don't tell you about that. So coming to the charts like this and using terms like risk on and risk off and looking at these sentiment indicators and these breadth of market indicators, gives an objective view. Even though I'm using subjective technical analysis, it gives a far more objective view than one-day opinions and conjecture and trying to predict the future and all that other garbage that happens in the noise world. We get away from that and we paint, tell us, let's see what the market's telling us. Let's listen to the markets. Let's read the price action. and let that be the judge rather than individuals coming up with their opinions of what may or may not happen. Okay, so John, okay, Simon, I've asked that. Right, so I'm looking at some other markets. Can't look at those at the moment. Right, so the financial markets believe that Trump is winning the war. Bruce is asking. No, I wouldn't. I don't think you can say that. Because now we're taking one statement and kind of imposing it on what the analysis is saying. What the markets are saying is that overall the picture isn't as bad as what is being painted. That may change, of course. And what I've tried to do today is use the tariff war and how the markets reacted to that to compared to how the markets are reacting to now, so we can get a good relative comparison. And I think I've made it plainly clear as to what's happening, and that's what I try and do over here. Because at the end of the day, you shouldn't change how you trade the markets because we're doing that mechanically. And we know that over the long term, over a large sample, the law of large numbers, that edge is going to play out. But what we don't want to do is knee-jerk react and change our process based on conjecture and noise that's coming out of the geopolitical events of the world to take us off our chosen path, because we know that works in the long term. And of course, if you break that process and you go into cash and suddenly there's a V bottom and the markets absolutely take off and you're not part of it when you should have been, well, that's breaking process. And why would we do that? Well, we spend a lot of time talking about the psychology of, we do that not because of the analysis. We do that because of our behavioral problems that we have in that we try and superimpose, or we don't, our subconscious does. It's trying to avoid things. It's trying to avoid things that we think would potentially harm us, and therefore, tries to see what's going to happen in the future. So that's what we're trying to break. But at the same time, I'm adding some evidence here as to try and counteract the geopolitical noise that's happening around the world by looking purely at price action and putting it into perspective. So that's what I'm trying to do over here. So I'm not trying to say that Trump's winning the war or anything like that. I'm just saying, really trying to put it into our own context. And Trump is a variable, the wars are variable, the tariff wars were a variable, politicians are variables, individual commodities are variables, every single participant in the market are variables, and all these variables all the time are interacting with each other. And if one variable does something, other variables don't just stand still and do nothing. This is a complex system, and we have no idea how all the other variables are going to react. So for us to form a single opinion based on one variable and say that therefore all the other variables are going to stay constant and not react in either a positive or negative sense, we can't do that. It's impossible for anybody or any group of people to know how all the variables are going to react to any single variable or group of variables. So what we do is we surrender to the fact that we don't know what's going to happen in the market, and nor do we need to know what's going to happen in order to make money, and that we have an edge, and that that an edge is nothing more than an indication of a higher probability of one thing happening over another. And so what we're going to do is make sure that we have that higher probability and that we allow that higher probability to play out in the markets. So that's what I'm trying to do here. And it's probably a long answer to your question, Bruce, but we don't need to get drawn into single variables and again, winning the war is an attempt to predict what's going to happen in the future. We just cut ourselves off from the future. We cut ourselves off from the past, and we act in the zone, in the now moment. And so we just do that by the presence of our edge in any given day or moment. And we work in days, not moments. And we execute according to that. And we know that over the law of large numbers, we're going to be ahead. That's how we do it. Okay. Right. Everybody else was, it's all going ahead. Okay, good. Got all the questions there. So another one, EC, while I very much appreciate the information being presented, what is the benefit of taking the time to follow these indicators if they are not taken into account in all the SPA3 systems? So I have, hopefully I've just answered that, EC. You live in a world, and that world is going to hit you with information, and it's going to be geopolitical information. It's going to be, in fact, let me be more derogatory about that information. I call it noise. We call it noise, right? And there's different kinds of noise, and most noise is counterproductive to what you're trying to achieve. And so what I'm doing is I'm putting that noise into perspective as a stepping stone to help you, not become discretionary. So you can stay non-discretionary, rules-based, and get more belief in the system. And what this does, because the system's going to act in its own environment without even knowing that all this noise is going on. And this helps put the noise into perspective. That's really what it's doing. So it counteracts, in a sense, it is also noise because it's not mechanical. But it's, in my view, it's better noise than the noise you're going to read about on the front pages of newspapers, or you're going to hear from brokers, or you're going to hear from market commentators on noise sites and on TV and all that sort of stuff, right? This is and there's different kinds of noise, and you can go and do all that research yourself, and white, pink, black, red, all sorts of noise, and on that spectrum of all that noise, this noise is trying to paint a picture that's objective, certainly using generic technical analysis, but more objective than what you're going to read in newspapers or read on all these market wire type sites and stuff like that. Okay, so that's the reason we do it. And our customers, they ask us for it. So not all of our customers, but some of them do. And if you find this is not helpful, then you don't have to watch it or join it. But it's overall, over the years, we've asked our customers, whether they want to keep doing this, and the answer's been overwhelmingly yes. And so hopefully that helps answer that question and put that into perspective. Okay, so let's look at commodities quickly, then we will finish up. So that is the CRB index. It's got a bunch of commodities in it. That indicizes, if you like, makes an index out of the commodities. It's an equal weighted, but it doesn't include gold. But it does include oil. So that spike we're seeing over here, and this is a weekly chart, is caused by oil. The next chart to look at is gold. So gold is in this long term. Look at that long term sideways breakout. That was $1,900 achieved in 2010, and then that might be 19 over there. But it struggled to get through. And I won't talk today about it. We'll do a secular bull market update at some stage in the next, probably towards May. And but you'll see this breakout over here, just classic technical analysis breakout. Look how strong that breakout's been. I have redone this channel compared to others. Look how gold is outperforming equities at the moment. And I have also just put another trend line over here to show the gradient of outperformance is actually changing. And what's forming here is a pennant, if you like. So we got a triangle forming over here, and we're going to see a breakout out of the way. The odds are, from a technical analysis perspective, is that this breakout will be to the upside, and the gold will continue rising. But that doesn't always happen. No, this isn't 100%. This formation, this pattern isn't 100% successful. It can certainly break out and then fall below. But certainly gold is strong at the moment. Silver is trying to catch up. So here is the relative strength of gold versus silver over the long term. Silver certainly had a breakout, but that was outperforming. Now it's underperforming gold again. So gold and silver, as you all know, are happening, are rising. So is copper. Copper's had a breakout of a long term. What is that? About a 16-year resistance line. That's what these things do. It's broken out, came back in big fall, and it's sitting near all-time highs as well. And here's oil. So there's Brent crude. I've redone this chart as well. So look what happened. So that's back in 2008. It got to $118 odd. And this is Brent. This is not sweet, but the big resistance here at this level. So it's been to these levels before. And let's go back to, right, so we can go back, I don't know the dates of all the wars, and you can go and pin them on there. But this chart goes back to, that's 1990 over there. And all of these have coincided with either resources boom or something that's caused the oil markets to do what they're doing. But that's certainly a breakout. We'll see whether that falls back into the range, this downtrending range, or whether it will stay above. Okay, looking at Bitcoin. So the big thing that I mentioned a month ago when we did this, and I'm not going to go through it now, is the propensity for Bitcoin to have 78.6% retracements. You can download these charts and you can look at the 78.6% retracements on this chart going back. You can import this analysis into your Beyond charts. But if we do have a 78.6, it also does 61.8, but 78.6 of the long-term moves, then we could see and going all the way down to the high 30s. But that's not a prediction. That's just looking at the characteristics of Bitcoin and saying if the characteristics are maintained relative to the past, then that could happen. Of course, characteristics can modify as well from time to time. And the same with Ethereum. Ethereum has not had a breakout to an all-time high from where it got to back in 2021. So long-term sideways moving secular market move over here, and it's in the mid-range of this. So not as strong as Bitcoin. And look at Platinum. So Platinum and Palladium are two others. Certainly a big move over here at resistance. It's hit resistance, fallen back into the range, and is challenging that resistance as well. If gold and silver continue, the odds are that Platinum is going to continue, break out of that range, and probably play some catch up. Sorry if I've got that chart, probably play some catch up with gold. No, I do have another chart. We won't do it now. And same with Palladium, below its all-time highs, middle of the sideways move, and you'd probably see Palladium along with Platinum try and catch up to gold as well. Silver goes first, that's typically gold, then silver, and the big long-term moves, and then Platinum and Palladium follow. So that's where I wanted to finish it. Are there any other questions? I did have a question session mid-range, mid-webinar. I think the summary is very much that there's a bit of confusion between long-term and mid-cap and small-cap stocks and large-cap stocks, and we are seeing that play out. But there is indecision as well, and that resistance here, and even this fall on the S&P 500 is relatively minor compared to what happened with the trade war, that the Liberation Day back in April last year. Okay, we'll finish it there. Thanks for your time and attendance. It happens to be around about a month since I did the last one, but I'll time these to when there's major things happening in the market that we need to go and just put some perspective by looking at price action rather than listening to the noise. I'll do that though. So it won't be done on a periodic time basis. It'll be done as and when needed. So thank you for your time, and we'll get this recording out today. And as always, I wish you consistent, objective, and peaceful active investing.